Okay, so you might have clicked on this video because the title read something like 90% of traders lose or something like that. But the reason I say this is because, in my opinion, the foreign exchange market is actually designed to make you lose in the sense that you watch a load of videos, you first start out, you find out about the foreign exchange, Forex, whatever, and you watch a few videos, they tell you you have to do this, support, resistance, whatever, and you think it works, you try maybe a demo, then you go in with the live money and you end up losing, and you're left thinking, the move went my way. Why did I lose? It actually went my way. I just got, you know, killed out of this trade. So why did I lose? I got stopped out. It leaves you thinking. So I'm going to explain to you why that actually happens and how you can prevent them losses from happening in the future. And you can apply what I'm about to tell you to your current strategies or adapt it to make your own strategy out of it. Now, the reason I've got this over here is it's a statistic I saw when I first started within Forex. I'm not sure if it's true, but I'm just gonna give you it anyway. I think it's more than 90% myself, but it's that 90% of traders lose 90% of their money within the first 90 days. Now, I believe this to be true because I know a lot of people that enter the foreign exchange market, they put their money in, and they literally blow their account within the first couple of months. And it happens again and again and again until you actually figure out what's going on, what's making you lose, and you figure out a correct, strategy, a way to read the markets and the charts properly. Now, I personally have blown accounts. Many people have blown accounts when they start. You're generally bound to blow an account. If you don't, then congrats to you. But whatever you're doing, keep at it, keep going at it. But generally, everybody is gonna end up blowing an account at some point. So that is why I say it's designed to make you lose. I'd say this figure's probably like 95%, not 90. It's probably higher because a lot of people do blow accounts, and I'll be explaining to you why. But first, I want to explain to you the general concepts, the three stages that the market goes through. These are just the three simple stages that I can identify and you can identify that the market goes through. Okay, so to start off, we can identify three stages in a market. So the stages to begin with, we can identify that an uptrend occurs within a market. We can identify this with a higher high, higher low, a higher high, a higher low, a higher high, and a higher low. And then we can also identify a downtrend within the market with this sort of pattern right here: a higher high, a lower low, a lower high, a lower low, a lower high, a lower low. So you can see that there's different areas of the market where we can identify an uptrend and a downtrend. It all depends on time frames as well, but you can always identify within the market you have an uptrend and a downtrend. They're the first two stages, and then another stage of the market is actually when you're in consolidation, when you're in a range, and you have your support and resistance lines. I said that the wrong way around, but here's your support line and your resistance line. So that's the third. So recapping, we have uptrends, we have downtrends, and that's a rubbish drawing, I can't draw. And then we have a range where we have support and resistance, higher high, higher low, higher high, higher low, lower high, lower low, lower high, lower low. Essentially, that is how we identify these things. So now that we can identify those three stages, what we want to be identifying is a range. So after we've had an uptrend or after a downtrend, or either or, we want to identify a range. So generally you're taught to trade a range or consolidation, whatever you want to call it, with support and resistance. So if we draw this right here, you're generally told when you start out on YouTube and stuff, or whatever, you get a course, they're going to tell you that you have your level of support and you have your level of resistance, and after you've seen a couple of touches, you know that is a strong support or resistance, and maybe you'd trade it on the third touch right here, and it'll go back down, and once again you trade it right here, it'll go up. But when you're generally trading this as a beginner, what you begin to realize is when you're doing this, right, you've seen there's a rejection here. Now you're thinking, also rejections here, here, and here, whatever. And now you're thinking, oh, it's going to reject from here again. But so you tend to place the trade here with a short position, let's say. And what tends to happen is you get wicked out and you're left thinking, okay, look, you get wicked out right here, and then it actually goes in your direction, and you're left thinking, what did I do wrong? What went wrong? You know what I mean? And because it actually plays out the way you wanted it to, but you just get stopped out, and you're left thinking, what happened? Same thing again here. You place a buy position here, and what you know, you get wicked out, but then it actually goes in your direction, and you're left thinking, what happened? Now, I want to let you know that you're not alone in this. It happens to quite a lot of people because people do trade support and resistance. It's the same with trend lines again. So if we're in an uptrend, you can be doing this right here, and you'll see that right here you're gonna trade this touch to the upside, but what happens, you get killed off right here, your trade cancels out, and then it actually goes up in your direction, and you're left thinking what happened, because the trade actually played in your direction. Now I may be waffling on a bit too much here, but I'm just trying to explain to you that you have your general concepts of resistance, support, and you basically trade in the touches, and what happens is it breaks through, but it actually goes in your direction. Now I want to introduce a concept to you, a smart money concept. Smart money is basically your institutions like your banks, your hedge funds, all them sorts of people who institutions who trade on the markets, and they actually manipulate the markets. Now they can see that you are trading these touches. Essentially, above the touches and below the touches is something called liquidity. Now let me draw here liquidity. Liquidity. Right here, you can see that there's liquidity sitting up here and there's liquidity sitting down here, because let me just redraw this right here. Okay, so because people are placing orders below here and here, essentially when it comes to this level right here, people are going to be selling, right? And where the stop loss is going to be, the stop loss is going to be just sitting above here. Same thing here. People are going to be selling from here. Where the stop loss is going to be, stop losses are sitting up here. Same thing here, stop losses are sitting up here. And on the other side, when people are buying from here, the stop losses are sitting down here. When people are buying from here, the stop losses are sitting down here. Now, that is something called a build-up of liquidity. Liquidity is sitting over here, and liquidity is also sitting down here. Now, I may not be explaining this too well, but essentially, just know that where you have a range or consolidation, or even in a trend line where there's quite a few touches, there's liquidity sitting there. Because why? Because there's orders sitting over here, the stop losses sitting over here, because people are selling from here. Each time it touches here, people are selling. Each time it touches here, people are buying. Now, you've identified that there's liquidity here because of stop losses. What does that mean? You may be asking. Well, the institutions know that there's liquidity being built up here. They're manipulating the market in this way so that they can grab the liquidity and move in an overall direction, because then it causes more momentum in the market and it allows the market to move. It allows the institutions to move to their desired location. Now, essentially, I will be showing this on a live chart soon, but I'm just trying to get this example in your head right now. So right here, let's say it touched here, there's more stop losses sitting here. Now, it comes up to here, people are going to be selling here with more stop losses here. You see, there's all this liquidity that's been built up here, and now people are going to be placing sell positions right here. However, now the institutions have built up a lot of liquidity, they're going to stop these people out. Now, at the same time, there's people who trade break and retest. So if it, let's say you have this, that's a bad drawing. Let's say you have this, you have some resistance right here, and let's say people want it to break, and then they'll trade it on the retest. So people also have buy positions there. So essentially, at the same time as stop losses here, people have buy positions here. So the institutions take out them stop losses. Now them stop losses have gone. The institutions have killed them stop losses. These sellers are out of the trades, right? And now at the same time, the buy positions have been activated because people are waiting for a break and retest potentially, or just a break of the structure, so that it can, because they're predicting it's going to go up to the upside after a break of structure. What do people do? They're going to buy. So there'll be buy positions sitting here. So at the same time it goes up, the institutions place a buy position with millions of lots, and then they also place a sell position, causing it to go down, to take these guys out of their positions. They've grabbed all this upside liquidity right here. There's so much liquidity up here. They've grabbed it all, sending it down. And next thing, what you know, they're most likely going to grab this downside liquidity sitting down here, killing off the sellers and the buyers. I also would like to say, I forgot to mention during the video, but generally it may go back up to the price where liquidity was taken, because the banks need to mitigate their loss, because they're in a heavy drawdown, they're in a heavy loss, because they placed a buy position originally. So it needs to go back up there generally, and so they can get out of them positions at a break even or a bit of a profit, and then it'll potentially carry on up or go back down. Now that may all seem confusing. I'm just going to delete all of this and recap it one more time before I show you on a live chart. Now essentially, once again, you're going to have your support resistance forming here. You got your resistance, you got your support. Sell orders are all sitting up here. Buy orders are all sitting up here.
Um, so essentially, we've got money sitting here, right? We got money sitting here. We got money sitting here, right? Money all the way below here, money above here. Now the institutions are going to want to take out the liquidity down here, kill everyone out of their positions, and then also kill the buyers, sellers right here. So they've killed the buyers off because the people were expecting a buy to happen here. They're also going to kill the sellers off right here because they take that liquidity and then they send it up in the intended direction it was supposed to go anyway. And the same thing can happen here. They grab this liquidity and send it down. Okay, so that is the general concept right there. I'll show you it on a live chart. So if we go down just below from that point right there, okay, so we've got a chart right here. We are on EG, Euro GBP right here, and we're going to be showing you an example of it right here. As you can see, I'll draw out the zones to make this easier for you. So right here, you can see there's a bit of a range going on right here, bit of consolidation sort of area right here. You can see um, prices consolidating in this region. And what we can do is we can identify that there is some resistance right here. I couldn't get the word out. There's some resistance right here. We can identify that because it keeps coming up here and it keeps rejecting. At the same time, we can also identify that there's some sort of you could say everybody identifies the support and resistance in their own areas. You could say it's down here. You could say it's down here. Now let's just say it's down here, okay? So we've got money sitting over here, and we've also got money sitting in these bottom areas right here because there's when it comes to this level, people are selling. Well, maybe they might not have sold on that first one, but after they've seen these two general touches, maybe this touch, they're gonna be selling right here, thinking it's going down. We're getting loads of rejections right here, you see, and then they'll be selling it here once again to the downside. I know this is the 15-minute chart, but just imagine this on higher time frames too. The institutions trade on higher time frames, not the smaller time frames. Anyway, people are gonna be placing sell positions right here. You guys probably have done this many times before. You've seen consolidation, whatever. You're gonna be placing sell positions at the resistance right here, intending for it to go down to here, so then you can place a buy position. But what do you know? It actually kills them traders off right here. You can see liquidity was grabbed up here. They grabbed because people will have been placing their stop losses right here. They'll have grabbed the liquidity right here with this upwards move right here. You see, it went up and then what do you know? It actually went back down in their favor. Now, if you would have placed a trade here, you'd have been thinking, oh yeah, it's going down my way. But then, what do you know? Liquidity is grabbed, and then it actually goes in your direction, and you're left thinking, why did that happen? What did I miss? You know, I was reading the charts correctly, and no doubt you were reading it correctly, but you were reading it from a retail perspective, not a smart money perspective. Now, now you can see that liquidity is grabbed. Now the buyers have been entered into buy positions to go to the upside. But what you know, they also get killed out and their liquidity is grabbed up here too. And what you know, the market goes in the intended direction to the downside right here. And at the same time, you have your sell positions, your buy positions resting over here. There's loads of liquidity here. At the same time, there's loads of liquidity sitting here because there's people with buy positions right here expecting it to reject like it rejected here, maybe reject like it rejected at these levels. And what do you know? It takes liquidity down here and it actually goes in the intended direction. So I forgot to mention this in the video before, but as you can see, when it goes back up, that is the institutions mitigating their losses and getting out of them positions that they originally bought with to send the liquidity up, to take the liquidity up. So they've got out of them positions and now it's going back down because they've got out of them positions because it was a heavy lot size. So that's how you know they've mitigated for the losses and now it's going to continue down. As you can see, I'll show you a couple more examples potentially after this, but as you can see, it happens time and time again. Now, you're probably wondering, okay, we can identify this, but how do we actually trade this? There's so many ways you can trade this. You could literally just implement this into your own strategy so you can notice where, you know, liquidity is being grabbed. And it's just good to know where liquidity gets grabbed, essentially, to incorporate it into your trading strategy or your trading plan. Now, I'm just going to give the example from the downside here. When liquidity is grabbed, it generally, like I said, it goes in the direction of, you know, where the liquidity gets grabbed, but it generally retraces and it goes back up the way it was the way you were predicting it to go anyway. So we're going to be looking at this example right here where liquidity was grabbed below here. There was money sitting here, and this liquidity was grabbed right here. And as you can see, this was the move that took the liquidity. Now,
The way we can trade this is actually because we know when liquidity is grabbed, it actually goes back in the intended direction. Now, it doesn't always happen. I'm not saying it happens 100% of the time, but we know it goes in the direction back, the way it was supposed to go. I'm not sure if I'm explaining this clearly enough, but it is kind of, clear in my head. If you do have any difficulties, let me know in the comment section. And if you are finding this useful so far, don't forget to hit that like button. It does help out the channel a lot. But essentially, we know it's going to go down and then head back up. So we can trade based on that. Now, I wouldn't recommend placing your trade solely based on that. You need some other confluences. But I'll just give you an example of how you could trade this. Now, we would look for a previous potential low or an order block. What I look for is an order block. Now, I'll explain order blocks in another video. If I've made the video, it'll be in the top right. If not, you can search YouTube about order blocks and what order blocks are. But essentially, people have their own definition of what an order block is. Let's just, for the sake of it, call this an order block. An order block is essentially the last down move before an up move, or the last up move before a down move. Okay, so this right here would be an order block. In my opinion, that is what an order block is. But right here, you can see it was kind of filled. But essentially, let's just call this the order block right here. So what you would look to do is look for a buy position at potential imbalances or order blocks. So let's say we would be looking for a buy position right here because liquidity is grabbed right here. We would be looking for buys around this area. Now you can go on lower time frames to perfect your entry. Generally, I trade at 50% of an imbalance or an order block. Okay, so I found an example for you guys as to how you could trade this. Right here, you can see we have a general resistance right there and a general support right here. I'm just doing an overall one. We've moved up to the hourly time frame. Right here, you can see it rejected here, rejected here, rejected here, rejected here. We're building a strong support and resistance right here. We had rejections. These were rejecting. All this was rejecting this lower support level, and then you have all these rejections right here. So essentially, we can see that liquidity was taken to the downside because we've got money sitting up here, we've got money sitting up here, and we can see that all this liquidity was being built up, and then once it was taken to the downside. Now, from a smart money perspective, we expected this to happen. We can expect liquidity to be taken right here. You've got the grab of liquidity. Now, the way we could place a buy position from this, because we know it's going to go back up and, go back to where we wanted it to, we could place a buy position based on an order block. Now, as I said before, an order block is the last down move before an up move or the last up move before the down move. We can see here we have just below this zone that we've made for ourselves right here where the liquidity was grabbed to, we will be able to notice that there's an order block right here. There's some order blocks right here. You could have waited for these ones or these ones, but I generally go for the first one that looks clear enough. So this is an order block because this is right here, this candle is the last down move before the up move occurred right here. So this is our order block. Generally, you can do it from the 50% of the candle or the open of the candle. I do it at 50% of the candle. So if you were to get your Fibonacci, I do it from body to body. I mean, you don't really need to do this because it's so small. But generally, I'm going to be looking for a buy position at 50% of the candle. You can also do it at the open, which would be up here, or from wick to wick. It's anywhere you want. It's your preference. But personally, I do it from the middle of the order block, the 50%. Now we're going to be looking for a buy position right there. You can see it actually wicked into that. You could go on the lower time frames, make sure you have your confirmations, look for rejections and stuff, and we would actually place a buy position right there. And what it does go up in our favor right here. We place a buy position right here. You see, you place, and for your stop loss, you're gonna want to put your stops generally just below structure. You're gonna use structure, and obviously the market, because this was a downtrending market, it is going down. But I'm just showing you this as an example. You want to have multiple confluences and stuff. Don't just trade this alone because you will realize when you do go on the markets, there's a lot of times where it doesn't work. But anyway, we will trade this to the next order block. That's how I do it. And then you'd have other order blocks to take profits. So right here, this is the last up move before the down move. So I would do it to here and we would have a nice 1 to 13 trade. There are many times where this will not work, and do not expect this to work every time, as you need multiple confluences, multiple things in order for it to happen. But this is just one example of a way to trade it. I'm just trying to get the idea into your heads of liquidity, so you know that there's money sitting here, money sitting here, and you want to be aware of it so you can implement it into your trading style. I'm just gonna leave the video there. I will make more smart money concept videos if you guys do want to see them. Let me know if you did find this video useful and helpful. If you did, don't forget to smash the like button.